Yeah, welcome everyone. I'm happy to see you guys. So if you love what I'm doing here, if you love the content I'm putting on, you can always follow me on Hive Blockchain as Justin Pencil, and you can always follow me on Twitter, Instagram, and on Facebook as Justin Pencil, right? So today we are going to be talking about market structure. So market structure is a very important topic in trading because with market structure you can be able to identify the trend technically without any indicator, without applying any tools. You're going to be able to identify the market structure, where you are in the trend, whether you're in a bullish structure or a bearish structure in the market, using your own psychology and your own technical knowledge based on the candlestick patterns, right? So yeah, so we are going to be identifying this today on this lesson. I want you guys to follow everything I'm going to teach you and take note of everything I'm going to be teaching you today. So the terms you're going to be using on the market structure aspect is we're going to be identifying the higher highs and the higher lows. So when the market is creating higher high, higher lows, higher high, higher lows, it means that the market is bullish. And when the market is creating lower low and lower high, lower low, lower high, it means the market is creating a bearish momentum. So what do? You plan on selling your on your lower highs, right? So yeah, so I'm going to be teaching you how to identify the structures here, and with these structures you are going to know when to buy in a bullish trend and when to sell in a bearish trend, right? So yeah, with this market structure you'll be on the safer side most times. So first thing is we are going to look into our chart, and as you guys can see on this current chart, you are going to see that we are in bullish trend. So for you to know if you are in a bullish trend, you can simply draw a trend line. Boom, you see that it's going up, right? So either in any way you want to do this, I just want to show you that you are in a bullish trend. So now as you can see, we are in a bullish trend. So the first thing you want to do is to, because we are not going to be talking more on trend line today, but we're going to be talking more on market structure. So we are going to analyze this based on market structure perspective, right? So now let's go down to it. Yeah, so whenever the market creates a low, you call here low. This is a market low and this is a market high, right? So this is the first structure on this trend. This is the first structure on this trend, right? This is the first structure on this trend. Now the market was able to create another low, and the market created another high. So this will become the higher high of this. It's called higher high, and this is the higher low. This is the higher low. So we have our low and we have our high. We have higher low and we have the new higher high. So this is how the structure is being created. Now you can also call this higher low, and this is higher high. Whenever the new high is being created, it's called higher high, and whenever the new low is being created, it's called higher low. But the first low is called low and the first high is called high. The next one created is called higher low. The next high created is called higher high. Just like that. Just like that. And it keeps on going, right? So the first thing you want to do is you want to make sure that you are in the right place. So the low, we have the low, we have the high, we have the higher low, and we have the higher high, higher low, higher high, right? We have the higher high, higher high. Now when you want to buy is always at a higher low. You always want to buy at a higher low. So you buy here, you buy at a higher low. You don't buy at a higher high, because each time you're buying at your higher high, you always experience a drawdown. So you don't want that. You want to buy at your higher low. Higher high is where you take your profit and you wait for a retracement to create higher low. Now the next thing you want to note is you don't want to see your low broken. As you can see, these lows, you don't want to see them broken. No. This is another low. You don't want to see it broken like this. You don't want to see it. No. Your previous low must maintain that momentum. That is a confirmed market structure. Whenever the low is broken, that means you are no longer in a bullish trend. You change your bias, you change your analysis. That means you stop buying and look for and watch what the candlesticks are doing. Then you know if you have to start selling or not. But yet, the first thing you need to note is make sure that your lows maintains this momentum. As you can see, they were able to maintain this momentum. There's no candlestick that was able to break this low down, and no. You see, they were able to maintain this momentum. That is a valid bullish trend. This is a valid bullish trend. So you have to buy at the higher lows. You have to buy at the higher lows. You have to buy at the higher lows. This is a confirmed market structure. When the market structure will be invalid is this, when our low is broken. As you can see here, the low, this is our higher low. This is our higher low. Now our higher low is invalid. It's no longer valid. Why? Because we see our higher high coming here to break this low. Our previous high coming here to break this low. So it invalidates this higher low. So we are not going to be buying anymore. So we start thinking of selling. Maybe market drop to goes up to that zone. Boom. That is what the market is going to do. So what do you do? Whenever you see this, you leave the market. So whenever you are buying, you probably should be putting your stop loss here, your stop loss here, your stop loss here, your stop loss here. So this is how you trade with the market trend. Moving with the trend. This is market structure, pure market structure, right? So now, if you want to know whether the new high is being created, this is how to know if the new high is being created. As you can see, you can draw your trend line here. You see that this is your new high. You call it your higher high. You can draw a trend line here. You see that this is the new high. You can call here your higher high. So this is how you move with the market. This is how you move with the market. Bullish. This is example of bullish market structure. Now let's go get example of bearish market structure. Example of bearish market structure. So we are going to be identifying the lower lows and the lower highs of this market structure here. So as you can see, this is a bearish trend. You can just use your trend line to draw this, and you have gotten your bearish trend. So now I have to know the market structure here, and for you to be able to know when to sell in this market structure is, or when the market structure is no longer valid. This is your low and this is your high. The next thing you want to find out is your new lower low. This is your new lower low, and this is your new lower high. So you'll be selling here. So you sell, you target to break this low. Then you have your new lower high. You sell here, you target to break this low. This is how you trade it. You'll be selling at your lower high. You sell at your lower high, and your TP should be at your new lower low. That is how to trade. Probably your stop loss can be here. That is how to trade this. Now you notice that your new lower high is no longer valid because of this push up. That signifies that the trend is about to change. What do? You start thinking of buying, no longer selling. As you can see, look at what the market is doing. Boom, push up. So if you're not using your stop loss, this trade would have given you a losing trade, and that is why it's good to always use stop loss. And where you should put your stop loss is just few pips above your new lower high. This is your new lower high, few pips above it. As you can see, this is working, guys. You wait for it to break. If it not break, I advise you just to like this example of it. You just wait for it. If it not see a break, if it not see a break in the market structure, is not valid. Example is this. This is not a valid structure. I'm just saying this now. This is not a valid structure because this low did not break. This low did not break this previous low, so it's not valid. It needs to break this example. Thank God for this. So you need to see it break this previous low before you can consider that high valid, right? Before you can consider the previous high valid, right? So now this is it. This is the lower low still. This is not a lower low because it was not able to break this low. So you have only this as your lower low, and you'll be selling here. You'll be selling here. It's only when this is broken you can consider it a lower low. But since the high is not broken, you are still in a bearish trend, right? So you enter here, and now you have your new lower low because this is your new lower low because this low is broken. So you have your new lower low here, right? So this is how it works. Make sure that the lower low is broken. So the structure should move like this. For the bearish, you should move like this. Something like this. Boom, 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 boom. Let the lows keep maintaining themselves. Are you seeing this? And let this high, make sure they are not breaking each other. So for the buy, you want to see something like this. You want to see the market move up, go down, move up, go down, move up, go down, move up, right? So this is a valid bullish market structure, right? This is a valid bullish market structure. So here is going to be your high, your low, your higher low, your higher high, just like that, right? We have what they call equal highs and equal lows. So the market, when the market creates something like this, when the market creates something like this, it means here is our, when you see market structure this way, this is our equal highs and this is our equal lows. Our equal highs and our equal lows. This is market structure. It means that the market is ranging. So you see it creating equal highs, equal lows, equal highs, equal lows. The market is ranging, is not trending. So this is an example of ranging market. So in our next video, we are going to be talking about multi-time frame session and multi-time frame and how to do multi-time frame analysis. That is analyzing with different time frames, drawing down to your own, like getting a bias on a daily time frame and getting your entry based on your bias on a lower time frame. We're going to be doing more of that in our next video. Yeah, so thank you guys.